Folks, Scott here, and this is the wrap for Tuesday, September 17th. Apologies for calling yesterday the 19th. I think I did it several times. It was a Monday, so that'll be my excuse. All right, today was interesting, and what makes today even more interesting is the fact that it came on the heels of yesterday. We had an large unfilled up gap yesterday. A little bit unusual to close down, but not completely unusual. We call this false down days, so it's a red candlestick, but we closed higher. And then today we have another unfilled up gap. So I just left the trading room here a few minutes ago and ran this particular test. I'm not going to run it for you now because it's worthless. It's only happened twice in the past 11 years, 2 times. So what you're looking at right there is it's not the second unfilled up gap that's unusual. It's the fact that today's high is inside of yesterday's highs. So you have 2 consecutive unfilled gaps, and you had an inside day today. So we gapped and didn't fill the gap again today, but we still did not manage or even test. That's what's remarkable to me. Didn't even test the high from yesterday. It's only happened twice. So real unusual price action here at the Fed meeting, and I guess you could imply that's incredibly bullish. I will warn you, I think around Fed announcements, easy to get faked out. We could have a real bullish day tomorrow, and it could mark, and I'm not saying it's going to happen, it could mark the high of the rest of the year. I've seen days that are bullish on Fed Day fall apart on the subsequent days and weeks, at least if my memory serves me well, which maybe it doesn't. But I think it's going to be interesting to see where we are a week from now. We did a survey in our room. I have a cool polling feature that we run from time to time, and the room was it was interesting. The room showed 2 to 1, meaning 2 out of every 3 folks in the room thought that the Fed would not announce any quantitative easing. I was in the minority there. I think they're going to announce the official start at some point. They may not start tomorrow, but they're going to announce the start of it. And by the way, my guess is no better than yours. But what was really interesting was that I then asked the question, where do you think the market will be a week from now? And it was 50-50. So it really tells you that there's a group of folks that believe there won't be quantitative easing, but the market will be lower. So that's an interesting thought, right? That would be the first time that that's happened. And it wasn't just 1 or 2. We're talking about probably 10, 15 folks that thought that. And we've got some real smart, experienced traders in our room. So it's just an interesting dynamic. I don't make predictions on where the market's going to be days and weeks from now, but real interesting market. Now that I've belabored that point to an exhaustive extent, let's get into what has happened historically when fading gaps on Fed Day above the 200-day moving average, and you closed it out at 1:45 Eastern, so 15 minutes before that 2 o'clock stop. And frankly, I need to change that to 12 because there have been some 12 o'clock announcements. So hold on. I probably won't change the numbers overall. If you don't understand these inputs, don't worry about it. We're going to do a demo next week. Watch for it in your email. If you're interested in gap trader, range trader, I need to change that to, we'll make it 12 even, I think is okay. Actually, to be very conservative, we'll make 11:45. You close out 15 minutes prior to the Fed announcement. Because some Fed announcements have been at 12, some have been at 2. So this is a very conservative view. And using end-of-day stops, targeting gap fill. And this will take a little longer than it normally does because I'm running the trading room right now for our members. I'm starting to leave the room open at night so people can trade the overnight and discuss and share thoughts and ideas in the overnight if they're interested. And I'm running Camtasia. And this computer is antique, 4 years old. Which is probably, I guess that's antique. Yeah, that's antique by PC standards. And there you go. It really doesn't change the numbers hardly at all. They're virtually identical to the 145 for those of you that are interested. Down gaps historically strong, 12 and 15. Winners, very profitable. Losers just don't go far against you. Biggest losers been less than 3 points historically. Up gaps, different story. 50-50 at best of being a winner. So be real careful on shorting an up gap. Now I will tell you, I also ran in the trading room. This is important to note. What happens after a 10-day high close, and it's been 6 of 6 historically, but that was holding till the end of the day, so I forgot to run the timestamp. But I have run some tests in the past, and I think the fact we're stretched to the upside increases the chances that if you have a small gap, maybe it's worth a scalp. I'll probably pass on. I think that will just be too risky, but just a little food for thought going into tomorrow. All right, today was looking like we may have a trade, which surprised some people, and I'm going to show you why. We ended up being a nominal gap, but let me show you what our worksheet showed. So if you take a glance at our worksheet, which just summarizes our gap guides, at a glance you knew a gap up today, opening between the high and the close, on average, across all 8 indices and our 3 systems applied, was a neutral setup, 61% win rate, 1.1 profit factor. However, whenever you have a down day, a lower close, or I should say a close that's below its open, those are D-based zones, and that brings in the DHO zone and the DOC zone. Go to our gap zone map on our homepage, just front and center underneath free info, and you'll see the 2 zones I'm talking about. And when you peel the onion back, as I like to say, and look at the odds for the DOC zone, it wasn't bad. Now, I did have one member say, I can't believe you were willing to trade this when the ES looks so poor. Well, I don't look at just one market, even though I primarily trade the ES. All these are highly correlated instruments, and if they generally are good, I'm generally going to trade them. And we had small sample size weighting this down. That's what the yellow means, real small sample size. So it wasn't really that bad. And let's see, the YM was good, neutral in the NASDAQ, favorable in the Russell, looking at the ETFs. Whoops. Favorable in the spider, so spider looked good, diamonds looked good, Qs were neutral, and then the Russell looked good. So 5 of the 8 met my criteria, and there were a lot of small sample sizes. And whoops, on the worksheet, which I did not point out, we had some positive factors. Day prior to Fed Day was a positive, unfilled up gap, big positive. After a false down day, slight positive. Looking at my comments on the worksheet, researchers showed last night did show a risk factor, but it was small sample size, and that was countered in my mind directly by the fact Tuesday of options expiration week during bullish markets, very positive for shorting up gaps. So bottom line, slightly positive overall setups for fading gaps in the DOC zone, mostly positive factors. For me, that was worth trading with one consideration. Small gap size was my concern, so I decided it needed to be roughly a 2-point opportunity, a 1.5. So if it opened at 16.93 1/4, I'd go short, assuming I got filled at 16.93. Then I could target one take above gap fill and make a 1.5. I was not going to go for extended target. That's why there was no mention of that. So I was willing to risk 5 or 6 points to make a 1.5 because the odds are pretty good. Fortunately, and believe me, I've got an ego, but it's been humbled enough over the past 10 years. I'm not about to sit here and tell you that I knew this small gap had a low chance of filling. That's why I didn't fade it. It's not the case. I got a little bit lucky. If it had opened at 3 ticks higher, 93 1/4, I would have been short and I would have been stopped. Okay, it's that simple. So I'm pointing this out also to remind people we all our brains, right, the way the human mind works, we tend to focus and give a lot of weighting, extra weighting, undue weighting to the bad events, the buffalo trades where you get stopped at the high of the day or narrowly miss getting filled. So you need to remember these positive events also. The 15-minute and first-hour range trades did not show anything unusually good. There was a slight bias for the high breakout. We were going right into resistance, so I passed on it. Technically missed a small win. Some folks took it. I did not do the gotcha at the end of the day. I actually got tied up with family stuff. Was unable to trade it, and it did cross my mind. Being inside the highs, I didn't have time to test it. I thought it may keep a lid on it as well, and it sort of did, but technically I missed a small winner in my end-of-day gotcha trade. And that was my day, and that is the wrap for Tuesday, September 17th. Have a good one.